Hello guys, welcome back to the part 2 of How Finance Works by Mihir Desai. Before starting our today's session, let me tell something about the course. And about myself as well. So my name is Samprit Roy, as I said, and I am a BCom graduate. I have done BCom honors in accounting and finance from Calcutta University. And someone yesterday asked me, why are you making such videos and wasting your time when there are only so few views on your channel? So there are main three reasons. If someone is watching, there are mainly three reasons for me making this series. First reason being, I need them myself at some point of time. Right, since I'm a BCom graduate, I think I will need them. uh, I will need these knowledges at some point of time later on, because few days ago I faced an interview where I was asked about financial ratios, and I completely messed it up. Right, I was not able to answer even a single question about financial ratios. That is when I felt that there would be many people like me who, after graduating from commerce background, might not be able to recall certain concepts. So this video is made keeping in mind all those people, right? Second reason is, I need to practice fluency, right? I need to practice fluency, and I am, as you can hear, I am not very good at speaking English. And there is not many people around my locality or around me with whom I can practice fluency. So this is a method by which I practice English fluency, right? So this is the second reason. Third reason is, right, this is the third reason, of course, why I am doing this. Because if I had anything in my priority above this work, I would have done that work only. But since I am not having much work in hand right now, I am free, so thought of why not make something which will benefit me in the future, right? So these are the three reasons why I am doing this. So let's start this series, right? So liabilities and shareholders equity. The second section, liabilities and shareholders equity, provides information on how companies finance themselves. Essentially, there are only two sources of finance for purchasing assets, that is, lenders and owners. Liabilities represent those amounts financed by lenders whom company owes amounts. Shareholders' equity or net worth corresponds to the funds that shareholders provide. So, what did we learn? Any asset can be financed in two ways, right? First is self-owned or financed, that is, you paid for that particular asset from your own pocket. And the second one is borrowed money. One, right? Now, when we are talking about liability, we are specifically talking about this sector, right? This source we are mainly talking about borrowed money or fund, any type of borrowed money which you have the liability to pay back, or you have the responsibility to pay back with some interest, is called liability, right? As you can see, table 1.6, where there are certain companies and the liability section of the balance sheet have been given. So these are the liabilities that the company have, or we can also say that from these particular sources, the company has raised its funds, right? For example, notes payable, maybe it is something related to the notes, or something which is liability, right? Definitely one thing for certain, it's a liability. Accounts payable, that means bills payable, that means I have purchased something for credit and now I need to pay the money back. Accrued items, that means uh, I have received money for certain products that I will manufacture and give to that particular person who have given me the money in advance, or in short, someone has paid me beforehand for this product or goods or service that I will be selling him on a later date. So it's a liability for me. Other current liabilities, it may include many things. Long-term debt, as I said, it may be debentures or uh, okay, long-term debt can be many things. I will discuss later on. Other liabilities can be many things: preferred stock, shareholders' equity. Now, this shareholders' equity is the equity share section. Those person who have financed me earlier for my capital, for raising the capital for my company, whom I have to pay back an amount, right? That particular amount is called dividend. We will study this later on. So let's go to the text. You might notice parallels in your life. Your debts, credit cards, mortgages, car loans, student loans have helped you finance your assets. A house, a car, and most important, your very valuable human capital. The difference between your assets and liabilities in your shareholders' equity or net worth. As you will see in table 1.6, the patterns of financing are different across all the companies and industries. Company G, for example, uses a lot of shareholders' equity as a source of financing. Others, like Company N, use very little. That mix of financing is referred to as capital structure, a topic we will return to in chapter 4. Liabilities are ordered by the length of time companies have to repay them, and the liabilities that need to be paid back soon are labeled as current. Right. So current liabilities are those liabilities which are to be paid back soon, and long-term liabilities are those liabilities which can be paid at a later date. Right. Accounts payable and notes payable. Accounts payable represents amounts due to others, often over a short time, typically to the company's suppliers. As I said, one company's accounts payable frequently correspond to another company's accounts receivable. Company A owes a large amount of money to its suppliers. Why would that be? One possibility is that company A is in financial trouble and can't pay its suppliers. Another possibility is that it willfully takes a long time to pay its suppliers. Which explanation is more plausible? Sometimes firms may have notes payable, a short-term financial obligation. You will notice that company N is the only one that heavily uses notes payable. Company N also has far more receivables than the other companies, making it look altogether strange. Which company do you think would look so distinctive? Here is a reflection. Previously, we considered the accounts receivable position of Walmart, Staples, and Intel. For each company, think about which customer might owe them money. In other words, which companies have accounts payable that corresponds to the accounts receivable for these three companies. Intel is the simplest example. It sells its chips to manufacturers of electronics with computing ability, so Lenovo or Dell would be its consumers. So Intel's accounts receivable corresponds to accounts payable of Lenovo or Dell. Right. So it's written in very simple terms. I hope you can understand. Accrued items. Accrued items broadly represents amounts due to others for activities already delivered. One example is salaries. A balance sheet may produce in the middle of a pay period, and the company may owe salaries that have not been paid yet. That means, suppose uh, in a particular month, a company have not paid its salaries to its employees, right? In that particular month, in the middle, if we make balance sheet of that particular company, in that case, those amounts which were payable as salaries, they have not been paid. That particular fund of that company will be recorded in the accrued salary section, right? This is how this term accrued means. That is what accrued means. That means you have to pay something uh, which is your liability, right? The employees in this case have provided services for which I have to pay them, but I have not yet paid. So that amount will be recorded in my accrued items. Next, long-term debt. As I said, I am not reading this up because long-term debt means, as we have studied earlier, long-term debt is any liability which will be met over a period of time, right? Which I have not the obligation to clear immediately. Those type of debts are called long-term debt. Preferred common stock. Shareholders' equity represents an ownership claim with variable returns. In effect, the owners get all residual cash from the business after costs and liabilities. Debt has a fixed return, interest rate, and no ownership claim, but it gets paid first before equity holders in the event of a bankruptcy. Equity holders have a variable return and an ownership claim but can be left with nothing if a company goes bankrupt. Typically, shareholders' equity, net worth, owners' equity, and common stock are all effectively synonyms. Shareholders' equity is not only the amount originally invested in a company by the owners. As a company earns net profits, those profits can be paid out as dividends or reinvested in the company. These retained earnings are a component of shareholders' equity because it is as if the owners received a dividend and reinvested it in the company, just as they did when they originally invested in the company. Right. So from this part, we got to know something about liabilities. So liabilities can be mainly categorized as two parts. First is debt, second is equity. Now, what is the difference between these two terms? You must have heard these two terms earlier. Now, the common difference between debt and equity is that in case of bankruptcy, right? Bankruptcy, that means when the company will dissolute, that means it will wind up. At that time, it doesn't matter if the company have fund left or not. The debt amount have to be paid mandatorily. But in case of equity, it can be paid or cannot be paid, right? If the company do not have funds, then equity will not be paid, right? But debt has to be paid mandatorily, right? So for paying debt, The owner of the company can even sell his own personal assets like house and land, etc., to repay the debt. But in case of equity, the liability of equity shareholders are limited up to the company only, right? I hope I am able to explain well. If not, we will got to understand later while reading, right? Only one company, that is company B, has preferred stock. Why is that? For that matter, what is that? How could one type of owner be preferred? Preferred stock is often called a hybrid instrument because it combines element of both debt and equity claims. Like debt, a preferred dividend can be fixed and paid before common stock dividends. But like equity, preferred stock is associated with ownership and is paid after debt in the event of bankruptcy. Preferred stock is unsurprisingly preferred when the world goes bad. Preferred stockholders get paid before common stockholders, and when things go well, they get to benefit from the upside, unlike debt holders as shareholders. Right. So there is something called preferred stock. Let me write here. Preferred stock, which has the characteristics of both debt and equity. Right. It has the characteristics of both debt and equity. Why is that so? Because preferred stock has the feature of debt that it will be paid before equity shareholders. It is part of equity in the sense that if things go well in the company, its funds will be reinvested in the company. That is why preferred stocks are very much preferred. Because if things go well, in that case, the fund generated will be again reinvested into the company. And if things go wrong, the preferred stock owners will be paid before equity shareholders. Right? Why would a company issue such a security? Imagine a company that has hit hard times and faces a risky future. Would you want to invest in their common stock if failure was a real possibility? And would you want to lend to it and only get a fixed return that might not correspond to the riskiness of the business? The unique attributes of preferred stock can allow a company to finance itself during precarious times. Right. So here is a unique feature of preferred stock, that is, I will explain why a company will issue such preferred stocks, right? Why a company will issue such preferred stock? We just like we read now. Why would a company issue such a security? Imagine that a company has hit hard times and faces a risky future. Would you want to invest in their common stock if failure was a real possibility? Now see, it is not like the company have much options, right? See, uh, here is a shareholder, Mr. A. Mr. A want to invest 100 rupees. Now, He has two options. No, he has three options, right? Either you invest in debt, you invest in equity, or you invest in preferred stock. Now, each of these options have certain limitations and advantages. The advantage of debt is that it will be his amount will be paid before any other shareholder, right? But its limitation is that the return on investment is very limited. For example, the return of investment, he invests 100 rupees, he might get 120 rupees, or even in that case, 100 rupees in certain cases, if the company is not able to pay the profit, it must pay the main amount, right? It is also permissible. But then, what is the profit of Mr. A by keeping his 100 rupees in debt, right? If he have invested this particular 100 rupees in any other field, for example, FD in bank, he might have got at least 130 rupees over the same span of time, but in this case his returns are very diminished, right? That is why debt is a very bad option. Now, why will he invest in equity? The plus point of investing in equity is that if the only if the company goes well, right? Only if the company goes well, in that case only its funds will be reinvested. For example, if 100 rupees is the price of one share, right? One share, in that case, uh, investing on equity, suppose its profits are the company earned huge profits over a period of 1 year. In that case, the prices of share will go up, right? Suppose 120, 130, 140. These can be the prices of equity share, right? So if he wishes, he can sell his share into the secondary market and immediately get the amount, right? In that case, this is the plus point of equity. But the minus point of equity is very dangerous. If the company uh, goes bankrupt, right? If the company goes bankrupt, in that case, it is very much possible that the prices of its shares will go as down as zero, right? In that case, they will never be paid, right? In that case, this entire 100 rupees is gone of Mr. A, right? This is why people will hesitate to invest in equity share of a company which is not going very well. But in case of preferred stock, it has the benefits of both debt and equity, but the disadvantages are reduced to a great degree when compared to debt and equity. That is why people may prefer these preferred stocks, right? Now we will understand financial ratios, and this is the most important part of this chapter. Now that we have had a chance to think about how companies are represented by their balance sheets, let's go to something even more meaningful in terms of analyzing a company. Financial ratios. Ratios are the languages of business, and finance people love to create them, talk about them, flip them upside down, break them apart, and so on. Ratios make numbers meaningful by providing comparability across companies and through time. For example, Coca-Cola's net profit for 2016 was 7.3 billion. Is that a lot of money for the company? It's hard to tell without context. Alternatively, knowing that Coca-Cola's net profit was 16% of its revenue, net profit divided by revenue is much more helpful. Likewise, knowing that Coca-Cola has 64 billion in liability may not mean very much. Knowing that 71% of its assets are financed with liabilities tells us a lot more about that company. You can also compare those ratios to other companies' ratios and to previous performance. Broadly speaking, the ratio in table 17 deals with four questions. First, how is the company doing in terms of generating profits? Second, how efficient or productive is the company? Third, how does it finance itself? The final question resolves around liquidity, which refers to the ability of a company to generate cash quickly. If all your assets are in real estate, you are illiquid, and if all your wealth is in your checking account, you are highly liquid. Right. So I hope you understood the meaning of liquidity, but still, let's see what is the meaning of this term liquidity. Most companies go bankrupt because they run out of cash. Liquidity ratios measure this risk by emphasizing the company's ability to meet short-term obligations with assets that can be quickly converted into cash. Suppliers like to see high liquidity ratios because they want to ensure that their customers can pay them. For shareholders, greater liquidity creates a trade-off. Yes, they want to ensure that the company doesn't go bankrupt, but highly liquid assets like cash and marketable securities may not provide much of a return. Right. Now we can see if this is the ratio section of the balance sheet where certain assets are or certain things are divided by certain other things to form up a ratio. Now we will study all such ratios, right? So the first ratio that we are going to study is current ratio, and side by side we will make note of these things, right? Financial ratios. So the first ratio that we are going to study is current ratio. Now the formula for current ratio is current assets by current liabilities, right? The current ratio asks a question on behalf of company supplier. Will this company be able to pay its suppliers if it needs to close? Will its current assets be sufficient to pay off its current liabilities, including those owed to suppliers? This ratio is a key way to think about if a supplier should extend credit to a company and if a company will be able to survive in the next 6 or 12 months. Right. Now it was written in a very easy language, so I hope you understand what is the purpose of current ratio. It measures its the current assets of the company in terms of its current liabilities. Let me write it down. Now let me give an example. Suppose there is Mr. A who is a supplier, right? Who supplies raw materials to company X. Now company X's uh, current ratio is 0.1 or 1 by 10. That is, for every 1 rupees of current asset, it has 10 rupees of current liability. Right? This is what it means. 1 by 10 or 0.1. That means for every 1 rupees of asset that he have, current asset that he have 10 rupees of liabilities. Then will Mr. A allow credit to this company? I don't think so. That's because he has a very low probability of getting back his dues, right? Because the company's current ratio says so, that it is very likely that he will not he won't get back his dues. So this type of decision is taken with the help of ratios of the company, right? Or this type of purposes the ratios serve. The next ratio that we have is quick ratio. What is the formula for quick ratio? Current asset minus inventory by current liability. Now, on the first gesture, we might see that we might come up with the conclusion that current ratio and quick ratios are same, or there are not much difference. But this thing, inventory, creates a greater degree of difference, right? Let me explain why this inventory is subtracted from quick ratio. In case of quick ratio, right? The quick ratio resembles the current ratio but excludes inventories from the numerator. Why make a big deal out of inventories? You might think inventories are about operations, but to finance people, inventories represent risk that needs to be financed. And inventory can be very risky. Think about BlackBerry, which competed in the smartphone market where products quickly grow obsolete. In 2013, the company released the Z10 late and was forced to declared that 1 billion of inventory was in fact worth zero. For companies with high risk inventory, the quick ratio provides a more skeptical view of their liquidity. Right? I hope you got this. The book gave us a very brilliant example of BlackBerry. Right? A very brilliant example of BlackBerry it gave us, that BlackBerry had manufactured a phone in 2013, Model X, and it when it was uh, manufactured at that time, the demand was great, right? Due for meeting the demand, it produced additional species of phones, right? It produced additional phones and kept it in the inventory, right? Now this inventory is full with phones. Now, what happened is, in the very next year, a new technology came because of which the existing phone became obsolete, right? For example, if I am, if two same phones are available, one with more advanced camera than the other one, then at the same price, right? This is also 10,000, this is also 10,000. Then obviously I will purchase the one with greater speculations, not speculations, more advantages, right? The phone which will give us more advantages at the same price range, we will purchase that. That is why this entire inventory or stock became obsolete, right? So that is why it is said that inventories can be very risky, uh, especially in when the industry is dynamic, right? The smartphone industry is very dynamic because new technologies are invented every now and then. So it is no guarantee that inventories will be entirely sold, right? So that is why in case of such industries which are highly volatile, in that case investors usually look at the quick ratio, that is current asset minus inventory by current liability, right? The third ratio that we have is profitability. Profitability can be assessed in a number of different ways because the appropriate measure depends on the specific question being asked. And profitability can also be assessed without traditional accounting based profit measures. As always, it's important to compare profits to something. For example, you could look at net profit or the income after all costs and expenses and compare it to sales to represent the margin or to shareholders' equity to represent the return to a shareholder. Both are key measures of profitability. One measure asks why, for every dollar of revenue, how much money does a firm get to keep after all relevant costs. The other, when you divide profit by shareholders' equity, asks for every dollar a shareholder puts into a company, how much do they get back every year? That is the notion of a return, specifically called return on equity. So the next ratio that we have is profit margin. Which is given by net profit by revenue. Now let me differentiate between these two terms, right? What is net profit? Net profit is that profit. Right. So net profit is that profit which the company retains after paying all its dues. And revenue, it is the total value generated directly from the sale of its goods or services. For example, a company sells the sales of a company is worth 10,000. But does it mean that 10,000 is entire this amount is his profit? No. 10,000 is not its profit because its revenue. From here, many things will be lessened. First thing that will be lessened is COGS or cost of goods sold. For example, if 10,000 is its sale, for example, cost price of this product, cost price of this 10,000 worth of goods that is sold is 5,000. That is 5,000 is our profit. It is called gross profit. From here, we will remove tax and other such things, right? For example, current expenses or some immediate expenses, and all these things we less from here, and it is found that 1000 is left. Now this 1000 is called net profit, right? So this is the difference between net profit and revenue. Now this ratio net profit by revenue tells us for every say single amount of revenue generated, how much profit does the company retain. For example, if uh, profit margin ratio is found to be 2 is to 1, right? Sorry, 2 is to 1 is not possible. Suppose 1 is to 2. It indicates that for every 2 units of revenue generated, it retains 1 unit as net profit, right? So that means 50% of its revenue generated is net profit, which is a very good indication, because such uh, type of ratios does not occur in real life scenario, right? Generally, net profit by revenue profit margin ratio is something like 0.0001 by 1 or something. This type of ratios are found in profit margin ratio, right? So let's look at the next ratio, that is return on equity. Its formula is given by net profit by shareholders equity. Right, net profit by shareholders equity. That is, uh, so I previously explained what net profit is, and shareholders equity is given by the amount of capital that is financed from the shareholders, right? From equity shareholders. So what does this ratio indicate? Let's see. This ratio, often called return on equity or ROE, measures the annual return that shareholders earn. In particular, for every dollar of equity that shareholders invest in a business, what is their annual flow of income? As two examples, company C has an ROE of 22%, while company M has an ROE of only 6%. Now see, what does this indicate? For example, suppose net profit is 1000 and shareholders equity was 10,000. It indicates that for every 1 unit of net, for every 10 units of, let me write it here, right? For every 10 units of capital raised from its shareholders, the company is able to generate 1 unit of net profit. So this is called return on equity. Okay.